Good afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for Monday, May 21st, 2012. Bloomberg reports investors are worried JPMorgan is planning to pull back in the European mortgage bond market in the wake, of course, of the CIO disaster. This could cause significant volatility. You see, JPMorgan is the biggest buyer of European home loan bonds. Is this just one of many examples of how JPMorgan's reckless $2 billion trading loss may be felt most by other people and other firms, while JPMorgan could, perversely enough, actually be the firm to benefit most? You know how this story typically goes.
You had nothing.
House always wins, Jonah.
The House always wins. We will make the case for what we're arguing with trader and Zero Hedge contributing editor Bob English. Also, the former Goldman Sachs director, Mr. Gupta, goes on trial for insider trading today, while entire too-big-to-fail firms arguably engage in this behavior as a matter of normal business by front-running their own clients. Meanwhile, it's revealed the same guy managing risk in JPMorgan's CIO was fired from a firm a few years ago for, why don't you take a guess, overseeing trading losses that resulted in a regulatory probe. So basically, despite billions of dollars spent on financial regulation that has increased over the years, we'll talk about what's missing and why it will continue to fall short of preventing the next systemic crisis. And the G8 summit came and went with leaders there. You see them taking in a little soccer. Oh, they also signed on to a communique where a top mandate read, our imperative is to promote growth and jobs. So as they seemingly sign their name to more screwed up central planning, they do so against the backdrop of this history. In the U.S., for the first time ever, those who didn't go to college at all may officially be better off than those that just went to high school. Those that went to some college. I messed that up, but I'll explain it all in a little bit. Let's get to today's Capital Account. Taking a look at the numbers, this is what we found. They seem to indicate then that when there is a crisis in the financial industry, in the financial system, there's a push to regulate. Take a look at what that amounts to. Here is the increase in federal spending on finance and banking regulation over the decades. You can see how that has increased. And here is the cost to financial firms spent on technology alone to comply with these regulations. Now, this chart starts from 2002. This is the year that Sarbanes-Oxley was passed. This was, of course, in response to the Enron accounting scandal. And then you can see how it's escalated. And after the 2008 financial crisis, we, of course, had Dodd-Frank regulations passed. And those are the estimated costs in complying. Again, this is just technology spending by Wall Street banks and fund managers, asset managers, in order to comply with these regulations. For what, though? For a London whale multi-billion-dollar trading loss at the quote-unquote best managed bank? That doesn't seem like a lot of bang for your buck. Our next guest argues these inherently flawed models keep blowing up because fundamentally nothing has been done to rein in moral hazard or assert personal accountability at these systemically dangerous financial institutions. And combine that with free money from the Fed, and you can look forward to more whales, London or otherwise, no matter how much is spent on Dodd-Frank or the Volcker Rule. And in this twisted world of these big, huge, too big to fail firms is one consequence of this trading loss, unintended or otherwise, that JPMorgan may actually stand to benefit from it. Well, Bob English is here. He's contributing editor for Zero Hedge and economicpolicyjournal.com, and he will make the case. First of all, it's so nice to have you on the show. Welcome back to Capital Account, Bob.
Thank you. It's very great to be here again.
Well, we always love having you. And first, okay, so let's really break this down. The ways in which this trading loss perversely could benefit or is benefiting JPMorgan, even though all eyes appear to be focused on them because of the $2 billion trading loss. First, this has, of course, attracted the attention of ratings agencies, and Moody's will reportedly conclude a review of financial institutions by the end of June. Some are expecting more downgrades of major banks, which can, to give an example to viewers who may not know, this can impact the cost of it can raise a firm's funding costs. That's just one example. What would be the impact, in your view, of more scrutiny, possibly more downgrades for both JPMorgan and its other competitors?
It's interesting that you bring that up first, because one of the first things to happen was the drawing of the attention of the the ratings agencies, and they focused on JPMorgan, and a few of them downgraded them or put them on negative watch immediately. But like you said, Moody's is putting the entire industry under review, and more or less they've committed to, and it's not certain yet, but they've committed to downgrading certain entities at the end of June. And what that means is the cost of them holding their trades on, in order the margin that they have to post, is going to be more. And what happens with firms like BAC and MS, when they get these collateral calls, they're going to have less capital to work with. And it disproportionately affects those that aren't as well capitalized as JPMorgan, which has the largest deposit base in the country.
So you're saying essentially the scrutiny that has come to this industry as a result of JPMorgan will result in other banks like Bank of America and Morgan Stanley, as you mentioned, possibly having a tougher time. It could weaken them, while JPMorgan is the best able to deal with things like downgrades.
Exactly.
Exactly. Okay, so there's Exhibit A. Let's move on. This is one thing that you pointed out to me, a truly obnoxious look at how the bank benefited from losing $2 billion via accounting magic. So JPMorgan announced this loss on a Thursday. The price of their bonds dropped after that. On that Friday, you pointed out that this drop in JPMorgan's bond prices resulted in a $5 billion gain for the bank that more than offset that $2 billion loss. How in the world did that happen? Can that happen?
Well, this bit of information comes via Sober Look blog, and they explain a methodology called debit value adjustment accounting, and it is indeed a bit magical. It has to do with a rule change that was blessed by FASB in 2008, and it basically allows a firm such as JPMorgan to price in its own default risk when the price of its bond goes down. Now, we're probably familiar with the way that hedge funds, for instance, have to mark to market their losses on bonds on a certain valuation date or reporting date, so that if they've bought a JPMorgan bond at 100 cents on the dollar, and at the end of a quarter it's 97 cents on the dollar, they have to take a 3-cent accounting loss, at least on paper. Well, JPMorgan is doing the flip of that, and it's all perfectly legal. They can actually record a gain on their liabilities in their net assets of 3 cents on the dollar.
So they benefit when their bond prices are going down for everyone else. That is absurd.
As do all the big banks.
As do all of the big banks through this accounting magic. Meanwhile, while we're on accounting, we've spent a little bit of time already on this show talking about the fact that this wasn't a hedge. But if you could just briefly, Bob, explain, when we're talking about in accounting terms, was this even accounted for as a hedge, the way that JPMorgan would have us believe it is?
Well, according to Francie McKenna, who was on your show Friday, the answer is no, because these, if you read their 10Q and 10K, JPMorgan specifically states that these hedges are not GAAP hedges. In other words, for accounting purposes, they don't qualify as hedges. Yet they're using the most convenient definition to try to sell to the public that, in fact, they are hedging whatever is going on in some other side of the firm. Mm-hmm. So, yes.
And this isn't the first time we've seen this kind of definition or disclosure arbitrage, is it? Is there another high-profile case that you can enlighten us with of another big major player using whatever was most convenient as far as disclosure or definitions in order to hide massive risks or losses?
Definitely. And it was done by none other than John Corzine at MF Global. Back in September of 2010, FINRA, regulatory agency for the broker-dealers, sent out a survey to all of its brokers asking them to report on their sovereign debt exposure. And MF Global replied in the negative that they had no such exposure. In fact, they did. They had significant default risk and credit risk in the broker unit to these sovereign bonds, but because of the way accounting rules are written, and they were able to book them or keep them off their balance sheet, they replied in the no. So once again, a firm using the most convenient definition at the time when it's most convenient for them.
A lot of magic going on, a lot of really good magicians pulling the wool over our eyes. Now, one of them at the top could arguably be Jamie Dimon. And when you thought about him before this, you thought about him as railing against regulation, railing against the Volcker Rule. Behind the scenes, his bank lobbying against the Volcker Rule or lobbying for loopholes. Then he goes on Meet the Press, and when he's pressed on this and the interviewer says, hey, you've been the biggest advocate of the fact that these regulations go too far, you've been opposed to the Volcker Rule. This is how he responded. Let's take a listen.
That's all completely untrue. And by the way, if anyone wants to go check the documents that I actually write every year in my chairman's letter, which I write myself, I get help, we have supported 70% or so of Dodd-Frank. We supported...
So he says, the interviewer, he says, that's completely untrue what you're saying. He didn't directly address Volcker Rule in that answer, I'll remind everyone, but he did say, we have supported 70% of Dodd-Frank regulation. My question to you, that feels like a backpedal to me of how we know Jamie Dimon. Do you think it's possible that he has at all tried or could be manipulating this trading loss to gain some political capital? Or try to?
Well, yes, the term you bring up is interesting, and the example is interesting because if you look at the CFTC's webpage, and they disclose all the public meetings that have to do with their part of the Dodd-Frank rulemaking, and JPMorgan is all over in that. So I don't know what exactly he means by support, but JPMorgan terms up on at least half of these meetings. And so you brought up before the fact that he had made this announcement, the initial trading loss, on a Thursday. And a friend of mine, Dave Harrison, at tradewithdave.com, brings up the very good question, why on a Thursday? Why not a Friday? Why go on Meet the Press? He could have buried this if he really wanted to with his connections, probably. But instead, he's doing a media whirlwind tour. So I think that's a bit questionable.
A bit questionable. We don't know exactly why or what could come of it, but there is a historical precedent, it appears. You brought to my attention Nomi Prince's article where she talks about the push by a certain high-powered banker for Glass-Steagall in the 30s. Do you see any parallel?
Well, yes, and I think she did. It was Winthrop Aldrich, who was chairman of Chase, and it was 1933, and Glass-Steagall was on the table, and he went to the newspapers and pushed heavily for it. All the other banks hated him for it, and it's kind of ironic because Aldrich's father had been one of the creators of the Federal Reserve System, and Glass-Steagall, of course, eventually went through, and then 8 decades later or so, we have the merger of Chase's biggest competitor, JPMorgan, and now we have JPMorgan Chase again in the same position.
Oh, the irony. It all just keeps coming back around. And one of the things, of course, we've seen from this is a push or a question about if more regulation is necessary or if this is Exhibit A for the Volcker Rule. And when we come back, you have some very interesting insight into how that is impacting smaller firms, the not too big to fail firms, the not Jamie Dimons of the world, the not JP Morgans, and our viewers are not going to want to miss it. So everybody stay tuned. We'll have more with Bob English, contributing editor for Zero Hedge and economicpolicyjournal.com. Also still ahead, while the G8 leaders were all business about job growth, or maybe, it seems the business of employment is changing. We'll give you our 3 cents in a 9 to 5 themed loose change, but first your closing market numbers.
Drives the world.
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
Welcome to the Alona Show, where you'll get the real headlines with none of the mercy. The problem with the mainstream media today is that they're completely disconnected from the viewers and from what actually matters to those viewers. And so that's why young people just don't watch TV anymore. If they want news, they go online and read it. But we're trying to take those stories that people actually care about and transfer them back to TV.
Welcome back. We're talking about the perverse world in which huge losses, well, for you or I, $2 billion is a huge loss. For JPMorgan, it's not. But in this perverse world where a $2 billion loss could be a gain for JPMorgan in many ways and a loss for a lot of other players. And of course, there is this call for more financial regulation or question about financial regulation that has come in the wake of this $2 billion, possibly more, trading loss. So far, of course, the Volcker rule, proponents have said this trading loss is Exhibit A for why we need it. I should mention there are all these loopholes already in the draft version of the Volcker rule, which big banks lobbied for, reportedly. So that's just one example, and who knows what else could come out of the regulatory fallout from the whale trade. But who really gets hurt the most and the least when it comes to complying with financial regulation? That's really the question here that we want to look at. So you can see right there how the costs have escalated, and that's just of technology alone. Complying with we're spending on technology to comply with the regulations. Now let's bring in Bob English, contributing editor for Zero Hedge and economicpolicyjournal.com, to answer that question. That's just very simple, Bob. Who does it impact more when you have financial regulation, a large firm or a small firm?
Very, very simple. It is the smaller firms, even the mid-tier firms. When they don't have the access to capital, when they don't have the access in terms of banks to securitization methods, when all they're doing is simply borrowing on the short end and trying to loan on the long end, these compliance costs disproportionately affect them more.
And when it disproportionately affects smaller, mid-sized banks more, which I imagine this is already happening with Dodd-Frank, what is the impact of that on the financial system or the economy? Is there any kind of broader big red flag that you see?
There's going to be a wave of consolidation. It's already begun. It began in 2008, but we're at the beginning of another one. And it's not just failed banks that are going to be resolved by the FDIC. There's going to be a wave of mergers and acquisitions, which is being helped along by TARP, the very system that was supposed to have helped these banks, or at least provided them a lifeline in the first place in 2008 and 2009.
So break this down, because you point out that you've found that a lot of these small and mid-sized banks that were TARP recipients, you say, are in default on preferred stock payments to the Treasury. So what does this mean and what's the significance?
Of the 700-plus banks that took TARP money, or I should say forced to take TARP money, about 400 or so are in default, and that means that they haven't been able to make the 6 or 7% dividends, whatever they might be for that particular firm, back to the Treasury. And about 300 or so of those are smaller banks.
Okay, and so what is the significance of that in your view? Because couldn't you just argue they're broke, maybe they need to go under?
Some of them do, and some of them will. But a lot of them are viable, smaller community banks, and the only thing that's keeping them down is this albatross over the necks of these TARP payments. And if one were to remove that, they would be viable entities, viable banks. Instead, what we're seeing is the Treasury has announced a program where they're going to sell off, and they've already begun this, They've done a program with 20 banks so far. They're selling off the preferred stock at a discount to PE funds and other banks, anybody who would like to come in and snap up these viable smaller banks and get their assets on their books.
And you've found that a lot of these PE firms, these private equity groups, have swooped in and tried to capitalize on these banks. You gave one example of what's in it for them. Is there anything else that can help convince us that there's something in it for these PE firms to acquire these small, broke banks?
You could just look at who's doing the buying, and it doesn't impute that anything is wrong legally here, because it's all perfectly legal, but that's kind of the point. And you have to ask yourself, why do we need a cottage industry built around the fact that governments are picking winners and losers? So one example is this bank, Bank of Hampton Roads, which is in Norfolk, Virginia, and it's been bought by a private equity group, a fund, that's managed by a former comptroller of the currency.
Let's get a little bit more into that. So tell me a little bit more about the situation that this bank is in, that you say is kind of the typical situation of these smaller firms that you're talking about.
Right. They have a somewhat troubled loan book, but they do have what appear to be some valuable assets. And this highly connected PE group or fund has expressed interest in this group and looks to be buying up a significant number of its shares.
And this is what we just saw on the Federal Reserve's website that you showed to us. It reveals that CapGen Capital, that's the group, is seeking approval to increase their investment up to 49.9% of the voting shares of this bank you're talking about, Hampton Roads Bank shares in Norfolk, Virginia, indirectly increasing their investment in the Bank of Hamptons. So give us a little bit more insight into who is the leader of CapGen. You mentioned his ties to the Office of Comptroller, but it's more than that.
Yes, his name is Eugene Ludwig, and besides being the former comptroller of the currency, he was a founder of Promontory Financial Group, a very prominent advisory firm that started in 2001. He's been an officer for various federal institutions and is generally a very well-connected guy.
Well-connected guy, picking off assets from these broke firms that are broke because of TARP, which is a federal program. So we've talked about a lot of things. Bring us full circle, Bob. What do you think is the big trend that's very concerning in your view coming out of all of this?
I think the big trend is the crowding out of smaller firms and mid-sized firms in general. And we see this not only in the financial industry, but in several others, and it's coming to what has historically been the most free, which is tech, but especially in finance, which is so heavily regulated. There's just no place for the mom and pop firms anymore, which is unfortunate because they're the ones that have the ability to know their local communities, that have the ability to make loans to people based on actual due diligence considerations and not some model that's failed however many times in the past. So it's a shame that we're going to lose this segment of the business, but that is the trend.
That is the trend. And as that happens, the too big to fails get bigger and stronger. And you pointed out one of the other things that can happen is they just eat up these smaller firms. So again, it could be an opportunity for the JPMorgans of the world. Bob English, we're going to leave it there. Thanks so much for being on this show, breaking down all this really complex but very interesting stuff and a unique take, in my view, on this JPMorgan trading loss. That was Bob English, contributing editor for Zero Hedge and economicpolicyjournal.com.
Thank you very much.
All right, let's wrap up with loose change. Dimitri and Shannon, we all know the job market is bad. We look at the figures all the time. But we do know that some major corporations have been creating jobs, had some very successful turnout for jobs hiring days. Here's one.
McDonald's hires thousands of clean-cut young men like these. The things they learn working at McDonald's will pay dividends throughout their lives.
Thank you, ma'am. Please call again.
Hopefully those dividends do pay off throughout their lives, because for the first time ever, it seems that college may not. Labor Department data shows the number of jobless workers aged 25 and up who have attended some college now exceeds those with just a high school diploma or less. So basically, if you have a high school diploma only, you're more likely to have a job now in that demographic than if you had some college. Maybe people that dropped out of college are just quitters.
I think that we've talked about this before, but I think that college education has become so diluted in value, and it's become like a racket, all right? It's a racket. It's a business that's not.
It's a racket in the sense that you rack up all this debt and there aren't those jobs available.
And you're racking up all this debt, and what are you going to do with that degree? So many people go to college, they get this degree, and it's worthless. It's absolutely worthless, and they're going to the workforce and they can't find a job because they got a degree in worthlessness.
Do you think that this speaks to the kind of jobs that are being created in the U.S. and being lost, that more of them, and I think facts do support this, are in low-paying service sector jobs, the kind that you don't need college for, and that could explain this?
Yeah, of course, absolutely. There's no,
Yeah. So, I mean, I guess the question is when you look at things like this and you see the G8 leaders getting together and watching some soccer and signing this communique, which is like, we'll all talk about this stuff but not really do anything, and they talk about jobs and growth. It's like, come on.
Well,
Either stop screwing stuff up or actually do something.
Yeah, I get it.
Let's move on, because speaking of job scarcity, men are now comfortable finding a position in fields dominated by women. We've seen it before.
You know, Greg's in medicine too, Larry.
Oh, really?
Yeah.
What field?
Nursing.
That's good. No, really. What field?
Nursing.
According to a New York Times analysis from 2000 to 2010, occupations that are more than 70% female accounted for, or more than 70% female accounted for almost a third of all job growth for men, double the share of the previous decade. So basically, men are just...
No, men are fighting back against this BS. Like, you're laughing. They're fighting back against this gender discrimination, this reverse gender discrimination.
Oh, you know
what?
Oh, this is great, because this is your favorite topic. You talk about this all day in this newsroom.
Absolutely.
You think you're being discriminated
against. This place is dominated by women. I'm like the only man here. I could file a lawsuit.
That's why you wanted to do this story.
I'm joking.
That's why you wanted to do this story.
I didn't pick this story.
You
Shannon
love
picked this
story.
I get Shannon.
Shannon, what do you think?
Well, basically, to that end, business journalism is actually more dominated by men. So Lauren's kind of making headway there.
No. It's the old guys drinking scotch and whiskey at the New York Times.
No.
Those guys are done. Okay, the new trend is people like Lauren and yourself, Shannon. I'm the only guy here. There's no one else here but it's me.
I'm still a trailblazer. No, I'm still a trailblazer in the traditional sense. You are going like, oh, well, actually, this doesn't make sense.
Exactly.
So let's leave it here. My argument falls flat. So let's hand it to you. Tell us what you think, because that's all we have time for. Thanks so much for watching. Make sure to come back tomorrow. In the meantime, you know you can follow me on Twitter at Lauren Lister and give us feedback on the show or catch any of the episodes that you missed at youtube.com/capitalaccount. Plus, you can catch our show in HD now on Hulu if you get the Hulu Plus version at hulu.com/capital-account. By the way, that's the only place you can see us in HD. From everyone here, have a great night. See you tomorrow.